They are telling you silver is dead. They are telling you demand is weak. They are telling you prices fell for a reason. That is the accusation. Because what is happening in silver right now is not a market. It is a containment operation. The price you see on a screen is not silver. It is paper. It is leverage. It is promises stacked on promises. And the institutions know this. They know the math no longer closes. They know the chemistry does not negotiate. This is not theory. This is published data. Behind the noise, something broke. Quietly, permanently. A supply chain assumption collapsed. A reserve estimate failed a stress test. A throughput model no longer clears physical reality. And the price did not react. That is the tell. When fundamentals shift and price does nothing, it is not calm. It is compression. Silver is not falling. It is being sat on. Because if it moves honestly, it does not drift. It gaps. This market has seen this movie before. The analysts were late. The headlines followed. The chart exploded only after inventory was already gone. What changed is not sentiment. What changed is flow. Silver is no longer a monetary footnote. It is an industrial choke point. Solar does not function without it. Grid infrastructure does not scale without it. High-density electronics do not miniaturize without it. Defense systems do not operate without it. And unlike software, you cannot patch around atoms. You cannot substitute conductivity. You cannot invent a replacement on a spreadsheet. You cannot cheat the periodic table. Every green transition deck assumes infinite silver. Every forecast assumes mines respond on demand. They do not. Primary silver mines are not growing. They are aging. They are depleting. Most silver comes as a byproduct, which means it is hostage to other metals, which means price signals do not summon supply. This is the math they refuse to run. You cannot double output when silver is not the product being mined. You cannot accelerate geology. You cannot train skilled labor overnight. You cannot permit a new mine in a political vacuum. Timelines are measured in decades. Demand is measured in quarters. That mismatch is not cyclical. It is structural. Price weakness is not a signal. It is camouflage. Banks understand this better than retail. That is why they are nervous. They do not need you excited. They need you exhausted. They need you to believe the story that this rally failed. That resistance is real. That upside is capped. Because if enough physical holders refuse to sell, the paper breaks. And the paper always breaks. This isn't about inflation narratives or fear trades. This is about flow physics. Inventories are thinning. Delivery times are stretching. Premiums are creeping. Those are not opinions. Those are symptoms. Paper markets clear at the margin. Physical markets clear at the bottleneck. When the bottleneck hits, price does not negotiate. Look closely at the behavior. Large players are not chasing momentum. They are securing optionality. They are leasing. They are swapping. They are rolling forward exposure quietly. That is not bearish behavior. That is preparation. This is the trap. They cap the price just long enough for disbelief to set in. They shake weak hands. They let commentary rot sentiment. And then the constraint asserts itself. Silver does not climb stairs. It waits. Then it takes the elevator. We have seen this pattern repeat across commodities that moved from surplus narratives into strategic necessity. The lab always leads the chart. The factory floor always knows before the headline. This time is quieter, which makes it more dangerous, because demand is no longer discretionary. It is embedded. Solar installations do not ask permission from price charts. Electrification mandates do not pause for futures positioning. Military procurement does not substitute ideology for conductivity. Silver demand is inelastic. Supply is brittle. That combination does not resolve sideways. The current price is not equilibrium. It is delay. And delay is valuable only to those who need time. Banks need time to source metal. Manufacturers need time to lock contracts. Governments need time to mask dependency. They all need time. You do not. This is not about trading the next candle. It is about understanding what happens when paper claims exceed deliverable reality. When that line is crossed, repricing is not gradual. It is violent, not because of speculation, because of necessity. Silver is consumed. It is not stored like gold. Once it is used, it disperses. Recycling is inefficient. Recovery rates are overstated. Energy costs matter. Another inconvenient equation. Every year, more silver disappears into products that are never reclaimed. Every year, demand stacks. Every year, inventories erode, and price pretends nothing is happening. That pretense has an expiration date. The $92 level is not a target. It is a containment ceiling. Above it, paper credibility fractures. Above it, margin assumptions fail. Above it, physical holders stop answering calls. That is why volatility is suppressed. That is why commentary turns dismissive. They want you bored. They want you cynical, because disbelief is the last phase before repricing. This is not a call to action. It is a warning about inaction. Those who wait for confirmation get paid in headlines, not returns. Those who understand structure act while price lies. Ignore the noise. Ignore the intraday drama. Watch the flows. Watch refinery throughput. Watch delivery delays. Watch industrial offtake. Watch what is not said. When the move comes, it will not ask permission. It will not respect technicals drawn in calm markets. It will gap through disbelief. That is how physical shortages announce themselves. This market is not broken. It is cornered. And corners resolve only one way. The question is not whether silver reprices. It is whether you understood why before it did. Because by the time 92 becomes history, the conversation will change. Suddenly the story will be obvious. Suddenly the urgency will be universal. And suddenly patience will look like foresight. Events are already in motion. The paper is thinning. The metal is leaving. Nothing about this is optional. The price will not warn you. It never does. It will move when the last assumption fails. When one buyer cannot be satisfied with paper. When one delivery does not arrive on time. That is how these shifts begin. Quietly. Privately. No panic. No headlines. Just a phone call that does not get returned. Silver is not scarce in theory. It is scarce in practice. On spreadsheets, reserves look adequate. In reality, those reserves are fragmented, locked behind geopolitics, locked behind permitting, locked behind energy costs, locked behind time. Time is the variable everyone underestimates. Mines do not respond to price spikes. They respond to decades of capital discipline. And capital discipline left this sector years ago. That decision cannot be reversed overnight. You are watching the consequences of that neglect surface slowly, like pressure behind a dam. The institutions see it. They just cannot say it. Because acknowledging scarcity is admitting exposure. So instead, they talk about rates. They talk about sentiment. They talk about positioning. They talk about everything except tonnage. This is how mispricing persists. The public debates narratives. The insiders track molecules. And molecules always win. Silver is a throughput metal now. Not a vault metal. It moves from mine to factory to product. With almost no slack. That is a fragile system. One disruption cascades. One export restriction tightens the loop. One energy shock slows refining. There is no buffer. The market pretends there is. That is the lie. When people say there is plenty of silver, they are quoting legacy data. From a world that no longer exists. A world before mass electrification. Before grid-scale solar. Before exponential data centers. Demand did not creep. It stepped. And supply did not follow. This is not bullishness. This is arithmetic. Every ounce used in infrastructure is an ounce removed from circulation. Every efficiency gain increases total deployment. Every substitution attempt fails the conductivity test. You cannot dilute physics. Banks understand the asymmetry. That is why they manage optics so carefully. They know that if silver trades honestly, it does not stop at headlines. It overshoots. Because short positioning cannot unwind smoothly in a physical squeeze. It snaps. The 92 level is not psychological, it is structural. Above it, leasing costs explode. Above it, hedges malfunction. Above it, counterparties demand metal, not promises. That is the point of no return. Until then, you get noise, whipsaws, false breakdowns, design fatigue. The goal is not to convince you. It is to wear you out. Because tired holders sell cheap. Strong hands do not. This phase is about patience, not bravado. Ignore timelines. Ignore commentators. Focus on inevitability. Markets can delay truth. They cannot erase it. Silver is not early. It is late. Late to reflect what already happened in factories, labs, and procurement offices. By the time the price acknowledges reality, reality will be months ahead. That is always how it ends. Not with chaos, with silence. Then a repricing. Not because people suddenly believe, because they no longer have a choice. When that moment arrives, there will be no debate, no second guessing, only adjustment. And adjustment does not ask who was patient. It rewards those who were. This is not excitement. This is resolve. The metal does not care who noticed early. It only responds to flow. And the flow has already turned. The rest is timing. Timing is the illusion that keeps people passive. They wait for a signal that feels safe. They wait for consensus. They wait for permission. But commodities do not turn on permission. They turn on constraint. And constraint does not announce itself. It tightens quietly, contract by contract, shipment by shipment, until one day something trivial fails. A delivery window slips. A fabrication line pauses. A procurement officer pays above spot and does not report it. That is how the shift accelerates. Not with fireworks, with paperwork. Silver's problem is not demand growth. That part is obvious. The real problem is that demand is synchronized. Energy transition, defense modernization, data infrastructure, electrification, all pulling at the same molecule, at the same time. There is no rotation out, no substitution cycle, just accumulation. And accumulation in a metal that disappears when used creates a one-way pressure. That pressure is already embedded. You can see it in procurement behavior. Longer contracts, non-cancellation clauses, quiet stockpiling. These are not bullish signals. They are defensive ones. Institutions defend when they know replacement is uncertain. Publicly, they downplay. Privately, they secure. That split tells you everything. Price weakness is the cover, not the message. The message is in behavior. Watch how aggressively paper supply expands when price rises even slightly. That is not confidence. That is fear management. They cannot let momentum attract attention, because attention brings questions, and questions bring audits. Audits bring delivery, and delivery is where paper ends. This is why silver is different from assets that can be inflated endlessly. You cannot print atoms. You cannot rehypothecate conductivity forever. At some point, someone asks for metal. And then everyone realizes how few people can actually deliver. That moment is not loud, it is decisive. The chart does not stair step, it resets, not higher. Truer. The vertical move everyone waits for is not speculation chasing price. It is price chasing supply. That distinction matters. Speculative moves fade. Supply repricing does not. Once a new base is established, it does not return to comfort levels, because the underlying stress remains. Silver will not spike and collapse. It will step into a new regime. And regimes do not reverse on sentiment. They reverse only when supply changes, and supply cannot change fast enough. That is the final asymmetry. Even if capital floods in tomorrow, even if permits are rushed, even if projects are announced, none of that produces ounces in the near term. Announcements are cheap. Metal is not. The market knows this. It just cannot admit it yet, so it performs disbelief. Disbelief is safer than honesty, until it is not. When repricing happens, it will feel sudden, but it will not be random. It will feel unfair, but it will be mechanical. Those who understood the structure will not feel surprise. Only confirmation. This is not about calling tops or bottoms. It is about recognizing when a system is misaligned with reality. That misalignment always resolves, not gradually, decisively. The calm right now is not stability. It is suppression, and suppression is finite. As inventories thin further, as demand locks in longer horizons, as alternative narratives fail the physics test, the market will be forced to reconcile. When it does, the conversation will flip instantly. The same voices dismissing silver will explain why it was obvious, why it was inevitable. They will speak in hindsight. You do not need hindsight. You only need patience. Patience is not passive. It is informed restraint. The hardest position is not buying. It is holding through disbelief. That is where most people fail. Not because they are wrong, because they are early. Early always feels lonely, until it doesn't. And when it doesn't, the move is already over. This is where resolve matters. Not excitement, not prediction. Understanding. Silver does not need belief to reprice. It needs delivery, and delivery is already straining. Everything from here forward is mechanics. The metal will move when it must, not when it is invited. That process has already begun, quietly, irreversibly.